the best credit card for every type of spender. Before we start, you may see a few ads. Thank you for letting them play, so I can keep bringing you free, actionable advice. Now let's continue. If you are searching for a high-level capital allocation strategy rather than just a piece of plastic, this deep dive into the 5 best credit cards by category for 2026 provides the rigorous financial framework you need to optimize your balance sheet. In this analysis, we will achieve 3 specific outcomes. First, we will identify how to use these specific instruments to enhance your 55-day float period. Second, we will audit the liability architecture of each card to ensure your business and personal assets remain siloed. And third, we will calculate the net cost of capital for each annual fee to ensure a positive internal rate of return. You will want to keep your ledger or notebook handy for this session, as we are moving beyond consumer-level tips into a sophisticated capital efficiency optimization framework that wealth management firms typically reserve for high-net-worth liquidity planning. The primary objective of any sophisticated spender is not merely earning points, but rather the strategic management of a liability structure. When we examine our first category, the premium travel sector, the goal is to lower the cost of international operations while maintaining high-velocity liquidity. This is where the first instrument enters the equation. The Chase Sapphire Reserve serves as a primary example of how a premium instrument can function within a liquidity management strategy. By utilizing its 3-to-1 earning ratio on travel and dining, an executive can effectively rebate a significant portion of their non-discretionary operational costs. Because the reserve offers a 1.5-cent redemption value through its internal portal, you are essentially creating a predictable cost basis reduction for all future travel expenditures. This is particularly relevant for those managing multi-currency expenses across the USD, GBP, and CAD zones, where foreign transaction fees would otherwise erode your margins. Beyond the headline multipliers, the reserve's primary rental insurance, trip delay protections, and airport lounge access function as embedded risk mitigation tools. These benefits reduce the need for separate insurance products, lowering your firm's operational overhead. The $300 annual travel credit effectively reduces the net cost of capital on the annual fee, improving the card's internal rate of return. The reserve also plays a role in global treasury management. Executives managing international teams can leverage the reserve's no-FX fee structure to consolidate global travel spend into a single ledger, simplifying audits and improving transparency across departments. This consolidation is a key component of institutional-grade liquidity planning. When viewed through the lens of corporate treasury management, the reserve becomes less of a travel card and more of a global liquidity stabilizer. Moving from personal travel to institutional-grade business management, we must look at how to leverage fixed-cost categories into scalable tax advantages. The American Express Business Gold Card is perhaps the most potent tool for a tax timing strategy involving high-volume advertising or shipping expenses. Under IRS rules, particularly for those utilizing cash basis accounting, the timing of your business deductions is critical for year-end tax optimization. By charging large-scale Q4 expenses to a card with a 4x multiplier on your top 2 spending categories, you are not only maximizing the rebate on your cost of goods sold, but also utilizing the card's billing cycle to push the actual cash outflow into the next fiscal year. This creates a temporal arbitrage opportunity. You capture the deduction in the current year while deferring the cash outlay into the next. For firms with seasonal revenue cycles, this can materially improve liquidity ratios and strengthen the balance sheet during slower quarters. The Business Gold also offers flexible category selection, allowing the card to adapt to evolving business models. As your firm scales, your top spending categories may shift from advertising to software subscriptions or freight. The Business Gold automatically adjusts, ensuring your capital efficiency remains optimized without requiring manual intervention. Furthermore, the card's pay over time feature can serve as a controlled leverage mechanism, allowing CFOs to strategically extend payment windows without resorting to external credit lines. When used responsibly, this feature becomes a microfinancing tool embedded directly into your operational workflow. For the executive who prioritizes simplicity and a fixed return on every dollar of capital deployed, we shift our focus to the catch-all business category. The Capital One Venture X business represents a pure play in capital efficiency for those who do not wish to micromanage category bonuses. When you are managing a firm where expenses are diversified across various vendors, ranging from legal retainers to equipment leases, having a flat 2 miles per dollar return ensures that no spend is wasted from a rewards perspective. From an institutional standpoint, this card acts as a hedge against the opportunity cost of complex tracking systems. It simplifies the cost of capital analysis because you can reliably forecast a 2% floor on the value returned for every dollar of accounts payable processed through the card. The Venture X business also includes employee card controls, lounge access, and strong travel protections, making it a scalable solution for firms with distributed teams. Its predictable return profile makes it ideal for CFOs who prioritize stability over variable category optimization. Additionally, the card's annual bonus miles and travel credit effectively reduce the net cost of capital, pushing the card's internal rate of return into positive territory even before factoring in spend-based rewards. This transforms the Venture X business into a predictable yield-generating instrument. Risk mitigation and liability separation are the hallmarks of a well-structured corporate financial plan, especially when dealing with secondary expenses. The American Express Blue Business Plus is a foundational element in a sound liability architecture for small to mid-sized enterprises. Because it frequently offers a 0% introductory APR period, it can be used as a low-cost bridge loan to finance short-term inventory or equipment without diluting equity or taking on high-interest traditional debt. More importantly, it keeps these operational liabilities off the personal credit report of the business owner in many cases, which protects the individual's debt-to-income ratio for future personal mortgage or investment property acquisitions. This separation of personal and commercial credit profiles is a critical risk mitigation framework that many novice spenders overlook. The Blue Business Plus also earns 2 points per dollar on the first $50,000 of spend, making it an ideal tool for recurring operational expenses that do not fit neatly into other cards' bonus categories. This creates a stable foundation for your firm's liability stack. When used strategically, the Blue Business Plus becomes a credit shielding mechanism, allowing business owners to preserve personal borrowing capacity while still accessing short-term financing for operational needs. Finally, we must address the optimization of high-frequency, high-volume overhead, specifically in the realm of domestic operations and employer-related expenses. The Chase Inc. Business Preferred provides a unique lever for cost basis reduction on recurring overhead, such as internet, cable, and phone services, as well as travel. By capturing 3 points per dollar on the first $150,000 of combined spend, a business owner can effectively subsidize their firm's entire communications budget through strategic point redemption. This is not about free travel. It is about optimizing the net profit margin of the business by ensuring that every dollar of essential overhead contributes to the firm's overall liquidity pool. When viewed through this lens, the annual fee is not an expense, but an investment in a high-yield rebate system. The Inc. Preferred also offers cell phone protection, purchase protection, and extended warranties, reducing the need for separate insurance products and lowering operational risk. For firms with multiple employees, these protections can translate into thousands of dollars in avoided losses annually. Before we conclude, it is vital to remember that these cards are not mere consumer products. They are sophisticated tools for cash flow management through credit. A strategic cash flow management framework requires that you match the specific card to the specific liability it is intended to fund. If you are using a travel card for advertising spend or a cashback card for high-value points transfer travel, you are experiencing a leakage in your capital efficiency. Historically, those who align their spending categories with the highest possible multipliers see a 3 to 5% improvement in their effective bottom line. Furthermore, maintaining a low credit utilization ratio across these institutional accounts ensures that your future borrowing capacity remains unimpeded, allowing you to strike when investment opportunities arise in the market. This alignment is the difference between consumer-level optimization and institutional-grade financial engineering. When executed correctly, your credit card portfolio becomes a micro-treasury system, generating yield, extending float, and reducing cost basis across multiple operational layers. In our final calculation, we must look at the net asset value of a three-card trifecta strategy. If an executive spends $100,000 annually across a balanced mix of travel, advertising, and general overhead using the cards discussed today, the blended return is typically between 3 and 4%. This translates to $3,000 to $4,000 in found money. That is largely tax-exempt when redeemed for business travel or as a rebate on business expenses. When compounded over a decade, this strategic spending adds tens of thousands of dollars to your net worth without requiring a single additional sale or a single hour of extra labor. This is the essence of institutional-grade financial management, making your existing liabilities work as hard as your assets. When executed with discipline, your credit card strategy becomes a silent profit center, quietly compounding value in the background of your business operations. Subscribe for more free institutional-grade analysis you won't find nowhere else on YouTube. Comment with questions or content requests regarding your specific business structure. Disclaimer: this video is for educating, equipping, and empowering purposes only. I am not your financial advisor. Please be aware that investing involves risks. You could suffer loss, and results are not guaranteed. Past performance is not indicative of future results. Always consult a certified professional before making any financial decisions.